Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, one of the things I've been talking about this morning is this three worlds, okay? So we're going to go right back to that piece because we want to finish out then with the third world, which is that there in the middle of index CDs through banks or fixed index annuities through insurance companies. Now here we're going to get, historically, the rates of return on those have done much better, okay, than say just a straight up fixed annuity. Now you're getting you're starting with all the guarantees of that world of protection, principal guarantee, some amount of interest guarantee, penalties for early withdrawal, of course, applies. But now we have a link of growth to a market index, like an S&P 500 index, or there are a lot of new indexes we'll talk about as well, and how those might work for you. Nationwide has some great pieces out there regarding fixed index annuity and the different types of strategies, different types of indexes that we can use in planning. So here, they have helped us stay ahead of inflation and taxes, and this is an area I've been using fixed index annuities almost since their inception, which is about 25 years ago, I think. So and I've had great success with those with clients over the years. There's a great piece, in fact, another handout piece that I'll make available. This one is Roger Ibbotson's piece on fixed index annuities beating out bonds as far as returns go. And this is an area where if you're looking at in your planning how you might, in fact, by swapping out maybe some bonds for fixed index annuities, how you can, according to Ibbotson in his article here and in the study that he did, basically you can increase your returns and at the same time lower your risk even further. So if you'd like to get that piece, just call my office. In fact, if you'd like to get a comprehensive financial plan done, and we're going to offer up a bunch, we're going to be talking about annuities more today. If you'd like to get, maybe you want to, as a part of that, get a second opinion about the annuities you have, or say, yeah, this is still the best annuity for me. Some of these older annuities that have been around, for instance, for 7, 8, 5, some of them even 5 or 6 years, there have been a lot of new products that have come out, and you could find it to be a lot better, especially if you've got some that are 8 to 10 years old. There have definitely been a lot of advances with fixed index annuities in that time frame, and some opportunity may be there for you to get even additional growth. So if you'd like the comprehensive plan, that would include, of course, we'll look at annuities as a part of that, and your overall financial plan, 615-376-5325. When you call in, we're going to gather up, just like I was showing you the information we would send you, the packet we send out, so that we can start gathering that information, determine what your income and your expenses, your assets, your liabilities. Again, we're going to factor in for inflation and taxes, and the reports we're going to do for you, basically do a report that will show you your financial future based on what you're currently doing. And by that, I mean it literally will have the final page of the report, in other words, will show your expenses, how much goes out every month, how much is, or every year, month and year, and then how much your income is. We adjust, of course, for taxes and inflation so that those numbers are realistic. Then we factor in what rates of return you're making on your money. We carry that on across any special income, any special expenses you might have, and then how much you're going to need to draw down from your accounts, your retirement capital, to supplement your income to be able to attain and maintain your standard living quality of life for as long as you might live, right? And to add in for fund money. So we get into it in quite a bit in RMDs when you need to start taking out required minimum distributions. We factor in the taxes for that. We talk to you about different strategies that maybe can help you in that planning. So if we can show you 5 years down the road, 10 years down the road, 20 or more years down the road, how much your money, whether you're going to see your money shrinking or growing or being able to maintain what you need for all your financial goals, and then share strategies if you're falling short or on how to improve it, okay, how to attain those goals that you're looking for. So if you'd like to get that kind of planning, at no cost, okay? I'm willing to put forth my time and energy and effort to help you, and as a way to also introduce you more fully to what we can do for you in my office. And maybe you'll become a client, maybe you won't, but there's no obligation we'll see what we can do for you first. All right, so we're willing to do that. If you're willing to put forth a little time as well, just call the office, 615-376-5325. When you call in, we'll get your information, send you out a packet of things to bring to your appointment with me. And in addition, when you do come in to see me, I'll also give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. And, you know, when it comes to the 7 steps, we cover that, all right? We talk about the planning piece, which I covered really basics of it. We then talk about on the planning piece, then we get into IRA Mastery, Chapter 3, which is on how to be more tax efficient with your retirement money as you're starting to take money out of those retirement accounts. You know, keep in mind, we're talking about a safe withdrawal rate, right? So if the safe withdrawal rate's 4%, you know, that was the old one back in the 80s and 90s. Well, if you think about that, if you've got $1 million, let's say, saved up to draw, you know, for retirement capital that you're going to be drawing from, 4% would be $40,000 a year that you could safely withdraw, let's say if you're in your mid-60s when you start that process. Now, with Morningstar, that would drop down to 3.3. That would only be $33,000. And if you look at American College study, then it was 2.5% safe withdrawal rate. So you're talking $25,000. That's a pretty big difference, right? From a low of $25,000 a year on $1 million to $40,000 a year. You know, as far as think about that, over $1,000 a month. That could maybe have a couple of nice trips in it every year, among other things. So how do we increase that? Well, I'm going to share with you, in fact, some ways that you can increase your income in retirement. We've got, you know, with using annuities, you can sometimes get I've got clients right now, in fact, getting 6, 8, even 10% drawdown rates on a guaranteed basis, right? Guaranteed to never run out. That's the kind of advantage that some of these annuities can provide. Now, at the same time, there are those that are not going to be as good. So it's about finding the right ones, and we can help with that as well. But think about that. If you could draw down 8% a year safely, or even 6%, you'd be taking it from 40,000 or a low of 25,000 up to 60,000, even at the higher end at 40 to 60. It's a huge difference in what it can mean for you in retirement, understanding how you can get these guaranteed income streams for life at a higher drawdown rate than would otherwise be safe to do. Okay, that's what good income riders and good annuities can provide for you. In addition, in fact, I'm going to offer up another piece, Annuities 101. So if you want to, again, for the office, we got a lot for you today as far as giveaways and stuff. But this is Annuities 101. I'm going to get into detail, but if you'd like a piece that also goes into some of that, we'll give you that if you call the office as well. All right. We're going to start with this piece on annuities. Again, the goal is we want to increase income in retirement. We want to do so safely. All right, in particular with volatile markets that we're seeing and coming out of one of the longest bull markets in history, what is it going to look like going forward? You know, a lot of experts that I read about and listen to, just like you do, I'm sure in the news, are saying that drawdown, you know, or that rate of return is likely to be considerably less over the next 5 to 10 years and possibly longer. So how do we, again, plan in retirement to get the income we need to attain and maintain our standard of living and quality of life, no matter how long we live, never have to worry about running out of money. That one of our biggest fears for all of us, right? Be in our, you know, mid to late 70s or early 80s, and all of a sudden be broke. None of us want that. So that's what good planning can help you do, and it's also in using the tools that are available in that good planning. We're going to be providing strategies as well as tools, such as annuities can be one of those tools. All right, so let's start with what is an annuity. So let's take a look at our first slide. This is from Nationwide. It's called Be Outliving Your Life, Not Outliving Your Savings. And I've shared this with you before, but we're going to take it from a little different perspective this morning. So what is an annuity? It's a financial product that can be customized to give you lifetime guarantees in retirement. Simply speaking, an annuity is a long-term tax-deferred investment able to provide protection for income, legacy, and spousal needs, issued by an insurance company, purchased through a licensed financial advisor, able to be tailored to your unique retirement. So this is, again, everyone's different. So there's a lot of different annuities out there. I just shared with you on the three worlds piece, for instance, the difference between fixed annuities, fixed index annuities, and variable annuities, just really basically. Well, now we want to break that down in much more detail about the different types of annuities and how they can be used in a good retirement plan and whether this might be a good fit for you. All right, but first we got to take a break. Join us here. We'll be right back on the Retirement Report.